We are looking directly at the Bitcoin News Digest for July 30, 2026.
Right. And our mission for you today is strictly analytical.
Yeah, evaluating Bitcoin's institutional maturation as it, collides with macroeconomic shocks, new SEC ETF structures, and some really critical network upgrades.
Exactly. The goal here is to separate the signal from the noise. We need to look past the daily headlines to examine the structural reality of the market right now.
So, starting with how the asset is handling current macroeconomic pressures, the FOMC just held rates at 3.50 to 3.75%.
Right. But with three hawkish dissents pushing for tighter policy.
Which, historically, that kind of macro shock triggers a flush of overleveraged longs, right? A cascading sell-off.
Oh, absolutely. And Bitcoin did dip. It dropped to 63,200.
But it bounced back almost immediately.
Yeah, right back up near the 64,744 mark.
Right. So what kept the floor from falling out this time?
Well, institutional mean reversion algorithms and really aggressive spot buyers. Instead of a panic, these automated systems they absorb the sell pressure.
So they effectively built a wall around that $64,000 mark.
Yeah, exactly. We're seeing this financial resilience that actually stems directly from the network's underlying physical security.
Right.
A recent Charles Schwab report calculated that executing a 51% network attack right now, it would require over $5.2 billion in hardware alone.
Okay, I have to push back on that a bit.
Sure.
Because $5.2 billion is, it's a rounding error for a well-funded hostile nation state. Is that price tag actually a deterrent?
Well, the upfront capital isn't the real deterrent. It's the economic asymmetry of the attack.
How so?
If a nation state somehow acquired that massive fragmented amount of hardware and attempted a large-scale chain reorganization.
Node operators would detect it instantly.
Right. Exactly.
So the moment the network forensic tools spot the attack, the fiat value of those captured tokens just collapses.
Right. The attacker spends billions to capture an asset they simultaneously destroy.
That makes a lot of sense. It's instant neutralization of their investment.
Yeah, exactly.
The physical base layer is practically unhackable. But when we look at the institutional wrapper being built around it, things get messy fast.
Very messy.
We're seeing major moves from the SEC regarding ETF structures. They just approved a Celo BZX rule enabling yield-generating Bitcoin ETFs.
Well, covered calls, yeah.
Right. And they granted a safe harbor for ETFs when they hit that 25% industry concentration limit. Why is that safe harbor so crucial for these funds?
Well, normally if you manage an ETF and your crypto holdings suddenly surge in value,
Just from price appreciation.
right, you might passively exceed that 25% concentration limit set by regulators.
Oh.
And without this safe harbor, fund managers would literally be forced to panic sell their best performing assets just to stay legally compliant.
Wow. So this new rule essentially means they aren't punished for Bitcoin success.
Exactly. It allows them to offer more complex strategies without fearing sudden enforcement action.
Okay, so we have regulatory comfort on one side, but then total fragmentation on the other.
What, the circuit fracture?
Right. Prediction markets are dealing with this circuit fracture. A Wisconsin judge just denied a CFTC injunction.
Meaning platforms like Polymarket are being forced into this really complicated state-by-state geofencing.
Yeah. So how does this patchwork of local crackdowns actually impact institutional capital deployment? Especially since the Digital Asset Market Clarity Act is stalled in the Senate.
Yeah, with only a 37% probability of passing in 2026.
Right.
Well, institutional capital requires predictability. When you have courts in different states issuing conflicting rulings on decentralized networks, that capital stays sidelined.
They just won't risk it.
No, institutions simply won't risk deploying serious capital into an environment where the rules change every time you cross a state line.
But even with that legal gridlock, the underlying tech ecosystem operates 24/7.
It never stops building.
Right. I want to look at how developers are bypassing these institutional hurdles, specifically regarding yield. Stacks just activated their PolX5 hard fork to introduce Bitcoin bonds.
Right.
How does this actually solve the risks we usually see with earning interest on crypto?
It tackles the custody problem. So historically, to earn yield, you had to hand your Bitcoin over to a third-party platform.
Or bridge it to another blockchain.
Exactly, which opens you up to massive hacking risks.
Right.
But this upgrade allows users to generate yield while keeping their private keys constrained entirely to the highly secure, Layer 1 Bitcoin network.
That's huge. It seems like every corner of the ecosystem is trying to mature simultaneously. I mean, Tether also just launched their UST stablecoin on the Celo network.
Yeah, to fully comply with the onshore transparency mandates of the new Genius Act.
Okay.
And that really ties everything together. When you look at the algorithmic defense of the price, the SEC enabling complex ETFs, and the rise of heavily regulated, transparent stablecoins.
You see the true state of the market. And for you listening, understanding these deep structural developments is how you look past the daily price noise.
It's no longer just about retail momentum.
No, it's about algorithmic floors and regulatory safe harbors. But it does leave you with a critical question to ponder.
What's that?
If traditional finance continues to wrap Bitcoin in complex ETFs, yield bonds, and highly regulated stablecoins, at what point does this natively decentralized asset simply become another cog in the traditional financial machine?